Good afternoon, everyone. This is OPG Advisors. We're going to do a brief talk about tax planning using constructed sales with short against the box. Uh, just a few basics to get you up to speed. So we're talking about owning a long position for a long-term hold with significant unrealized appreciation that the investment team is considering potentially selling or paring back. We'll talk about using short-term exceptions here to add some value, protect some tax liabilities, potentially defer those and gain a lot of value after tax return basis. What are some critical dates, trading costs, and the both investment and business side processes in order to do this. So just showing on screen briefly here a very simple example. We're talking about owning 500 shares of XYZ. It's achieved long-term holding period. You bought it at $100 a share. It's currently worth 200 a share. So you've got unrealized long-term gain in it. Instead of just selling it outright, you can consider putting a short position on for the same 500 shares, creating a fully boxed position, which keeps its long-term unrealized character. And now at the end of the year, you have this fully boxed position. You haven't actually made a decision yet as to the realization of that position for taxes. So you have until January 30th of 24 to make that decision. You essentially got a free look. You can do two things. So option A is at some time between boxing it and the end of January, make a decision that you don't want to try and do a short-term trading exception with. So you pair down the position long against short. It's a book entry at the prime broker. The gain goes back into 23, same as it would have. Absolutely nothing changes from if you had done a sale originally. But during that free look period, you have an option to also consider closing the short side or covering the short and going back to being naked long. And then doing that by January 30th, 24, settling it by then, which means I believe you have to trade it by January 26th of 24 so that it settles. That date changes a little bit every year. And then staying naked long in that position for another 60 days unhedged, essentially taking exposure for 60 days only. Once you do that and 60 days is told, let's assume you do this on January 26th, you go into March, you can then either sell it or rebox it or stay long. Whatever you do then, the gain is now put into 24, so you deferred this very large long-term tax liability, a year present value. These interest rates especially is very valuable, and then you continue to do that year over year on a deferral basis. So it's a very interesting technique, works really well, especially in public markets and equities. If you want a little bit more detail on it, happy to discuss it. I hope this was helpful. Thanks.